Good morning, students. So today we will be continuing with the discussion on portfolio management. Let us start the session from question number 15. So in question number 15, it says that following are the details of a portfolio consisting of 3 shares A, B and C, in which they have given us the portfolio weight, beta, expected return and total variance. Standard deviation of the market also they have given us 10%, and they have given us the covariances within all the 3 securities, which is within all the 3 combinations they have given us the covariances. Now this is asking us to calculate a lot of calculations. So first they are asking us to calculate the portfolio beta. So students, if we go step by step and try to remember what we have studied in the previous sessions, so we will be definitely be able to solve this. So let us start. So first we are required to calculate the portfolio beta. Calculation of portfolio beta. Now we have been given for calculating the portfolio beta individual betas of the securities and even the portfolio weights. So portfolio beta is a very simple calculation, which is the weighted average portfolio beta of individual securities. So let me plot security A, B and C. Similarly, the weight is given to us in the question itself, 0.20, 0.50 and 0.30. Beta is also given to us in the question itself for the respective securities, 0.40, 0.50 and 1.10. Hence the weighted beta comes out to be 0.40 multiplied by 0.20, correct, which is 0.08, then 0.25, 0.33. Okay, so the first part of the question, and if we total it, the summation of it will give us the first part of the question, which is the portfolio beta. This comes as 0.66. Okay, so students, if you note that the individual securities beta is from the range of 0.40, 0.50 to 1.1. Some is lower and some is higher. But the portfolio that we have constructed basis the weights given, the beta comes out to be 0.66. Now, second part of the question says, calculate the residual variance of each of the 3 shares. Now, whenever we talk about residual variance, always Sharpe's index model or single index model that we have already studied will come into picture, because that is the only model that talks about the residual variance as well as the systematic variance, correct? The systematic risk plus unsystematic risk all put together is the risk. So that is the only equation from where we come to know about the residual variance. So let us apply that logic. So if we have a total variance, so what we have studied earlier is total variance is equal to systematic plus unsystematic, and this unsystematic is also called as residual, right? So if we can find this total variance and systematic variance, we can definitely reach on to the unsystematic variance, correct? Now if you see, students, total variance, is it given in the question? Yes, the total variance is already given in the question. Now, is systematic risk given in the question? Directly it is not given, but we have been given all the inputs to calculate the systematic variance, because systematic variance also we know that is equal to beta square standard deviation of market square, which is the variance of market. Correct? So let us first plot the total variance here, which is as per the question. 0.015, 0.025 and 0.025, 0.100. This is the total variance. Now if we talk about systematic risk in terms of variance, okay, this will be, what is the beta here? 0.40 square, and the standard deviation of market is how much? 10%. 10% square. Correct? Similarly, the next point will be 0.50 square, 0.10, which is 10% square. Correct? And lastly, we have a beta of 1.1 square, 0.10 square. This will give us the systematic risk, or the risk from the market angle, right? That we have studied in the Sharpe index model. From the macro factor side, this is the risk. So this comes out as 0.4. Yeah. 0. I'm just writing the values here: 0.016, 0.0025, 0.0121, and the unsystematic risk is nothing now but the total variance minus the systematic risk in variance. So 0.015 minus 0.0016 will be the unsystematic risk. So which comes out as 0.0134, 0.0225, and last one is 0.0879. This is the unsystematic risk, or the residual variance. Both the terms are same, whether it is a residual variance or is it a unsystematic risk. Now, the next part of the question is to calculate the portfolio variance. Portfolio variance we know. Now, portfolio variance, when it comes, so we have studied that as of now there are two ways to calculate portfolio variance. One is as per the Markovitz portfolio theory, which is the modern portfolio theory, MPT, and another one is the Sharpe's index model, which is the single index model as well. So question is asking us to calculate the Sharpe's index model, because if you want to calculate through Sharpe's index model, you would need the systematic and unsystematic risk of all the securities, because that only you will multiply with the weights. Correct? So second part is what we have solved here. Now let us come to the third part. Calculation of portfolio variance. This is using Sharpe's index model. Now, students, if you see, we have already calculated the portfolio beta. Now, if you remember, what does the formula says? Beta square, standard deviation of market square, and with respective weights we have to multiply. That is for the systematic risk, plus here it was the residual variance, which is the unsystematic risk, multiplied by the weights. and then taking a sum of all the observations. This was what the formula is. It's just a simply multiplying by the weights. Correct? So even for weights also we said that we have to put the square. Why? Because we are talking about the variance here. Okay. So already now there are two ways to look at it. One is that beta square, weight square, and then taking the market variance. This is what the portfolio beta is. Correct? Because already this is the weighted average beta. So this we have already calculated as 0.66. So 0.66 is already calculated as portfolio beta, but that we have to put a square because this is beta square respective weight square multiplied by 0.10, which is the market standard deviation. For that we have to put the square. And now for the respective securities we have the different unsystematic risk. Now we will take those variances. The first one is what? 0.0134 multiplied by what is the weight? 0.20 square. Correct? Then the next one is 0.0225 multiplied by 0.5 square, because the weight is 0.5 for B. This is for A security, this is for B security, and the last one is for the C security, which is 0.0879 multiplied by 0.30 square. I'm just removing this so that there is no confusion, because it might look like we are dividing it, but we are not dividing it. We are just taking a summation of it. Okay. So the portfolio variance comes out to be, if we solve this, 0.0184. Now in the question they have asked us portfolio variance only. They have not asked us to calculate the portfolio standard deviation or portfolio risk. In case portfolio variance is asked, so this is where our answer is finished. Okay, students. So this is using the Sharpe's index model. We have applied both systematic and unsystematic risk to calculate the portfolio risk, portfolio variance. Now let us go to the third part, portfolio variance on the basis of modern portfolio theory given by Markovitz. This already we have studied. Now for this thing we know that first of all we have to analyze whether it is a two security situation or it is more than two security situation, because in case it is more than two security situation we have to follow the matrix approach. Now this is a definitely more than two security situation because there are three securities that are involved. So this is part number 4, sorry. So calculation of portfolio variance using Markovitz portfolio theory. So A, B, C and A, B, C. Now as per the formula, students, okay, just let me go back to the first part. So Namita is asking how do we calculate this 0.0134, 0.0879 figure. So Namita, what we have done is, see, this is A and this is B. Here we have done A minus B. Total variance minus systematic variance. So 0.015 minus 0.0016. It comes as 0.0134. Okay, Namita? So this minus this number. Similarly, 0.025 minus 0.0025. Correct? 0.025 minus 0.025. 0.0025 if we reduce, so it comes at 0.02 to 5. Okay, Namita? Now, in the matrix approach, we have studied that either we can make use of R, which is correlation coefficient, or we can also make use of covariance, correct? Now, if we make use of R, we need to additionally have the standard deviation of the respective securities. So R of respective securities multiplied by the standard deviation of respective securities, or we can just simply take the covariance and multiply the respective weights. So first of all, let me do one thing. Let me put weights here: 0.20, 0.50, and 0.30. These are the weights that are given in the question. Okay, students. Now, if you see the covariance, see now if you see in the question what is given to you, R or covariance? Definitely covariance is straightforwardly given to us. So let's apply the covariance and multiply it with the rates. So here, first of all, we will have to put covariance of A versus covariance of A, which is covariance of AA is nothing but the variance of AA, right? Because as I told you in the first session of the portfolio management, covariance is between two securities and variance is within one security. So if we talk about one security, it will always be variance. So what is the variance, or what is the standard? Yes, see, the variance of A is given as 0.015. So we will take the same 0.015 multiplied by 0.20 multiplied by 0.20. One weight is for the A in column and one weight A is for in the row. Okay. Then what about the covariance of A and B? A and B. That is also given to us in the question. Covariance of A and B is given as 0.30. So 0.30 multiplied by 0.20, which is the weight of A, multiplied by the weight of B, which is 0.50. Very easy and very simple. Then we have to see what is the covariance between A and C. So A and C covariance is given as, let's go and check, 0.20. So here 0.20 multiplied by weight of A is 0.20, weight of C is 0.30. Similarly, I am just writing the other numbers also. So if we solve this, now B to B is nothing but the variance of B. So 0.50 multiplied by 0.50, which are the weights, multiplied by 0.025, which is equal to 0.00625. Then comes between B and C. So covariance between B and C is how much? 0.40. Correct? So the covariance between B and C is 0.40. 0.40 multiplied by weight of B is 0.50 multiplied by weight of C is 0.30. 0.006. Then C and A. See students, one more thing is between this C and A or this A and C, the value will be same, right? Whether you take CA or AC. So we can just simply write this value only here, 0.0012. Then C and B will be this value only, which is 0.006. And then lastly, C to C will be 0.30 multiplied by 0.30 multiplied by what is the variance of C? Variance of C is 0.10. Okay, so this comes as 0.009. Okay, students. So if we just total this in both horizontally and then vertically, the value comes out to be 0.03625. Now, can anyone tell me what is, okay, so let me only tell that because it's clearly visible here. So as per the Sharp index model, if you see the variance comes out to be 0.0184, and as per the Markovitz portfolio theory, it comes out as 0.03625. So in the previous session, there was a query that using both these methods, there will be a difference in calculation, definitely. And at that point of time also, I told yes, there will be a difference in calculation. And through this question also, we can see that. Because in Sharp's index model, it always relates to the movements of market. So there they always assume that there is an independent variable called market and there is a dependent variable called that security or that portfolio, and hence all the movements is studied in that manner. But as far as the Markovitz portfolio theory is concerned, they will study the joint variability in which covariance correlation coefficient use is involved. So Namita is asking, in matrix approach, how we replace R with covariance is not clear. Okay. So Namita, for this, we have to go back to what the formula of R is. RAB, which is correlation coefficient of A and B, is equal to covariance of AB divided by standard deviation of A, standard deviation of B. This is what we have studied as per the formula. Now, I can write it like this: RAB multiplied by standard deviation of A, standard deviation of B is equal to covariance of A, B. Okay. Now, if you see in the matrix approach, either we can use this and multiply with the respective weights of both row and column. So I am mentioning use this and multiply with weights of A and B, correct? You will get this number. So let's say this number, correct, between A and B. Or the second approach can be that you use this R, standard deviation of A, standard deviation of B, and then you multiply. So this is, I'm putting or, any one of this can be used. So use this and multiply with the respective weights of A and B. Okay, Namita. Since in the question ready-made covariance was given to us, hence I have taken the covariance. Otherwise, the second option could have been using the covariance and the standard deviation. We could have arrived at R for all the combinations, which is the 3 combination. Then using that R, again multiplying with standard deviation of A and B and multiplying with the respective weights, we can also follow the matrix approach. But that would be a very lengthy process. Okay. I hope, Namita, this is clear. Now, Namita, from the previous lecture, there was a query that you have raised is on the arbitrage pricing theory, in which you asked that all the factors are independent factors. So basically factor 1 is different from factor 2. The answer to that question is yes. All the factors are very much independent factors. So factor 1 is separate, factor 2 is separate, factor 3 is separate, and factor 4 is separate. And hence their risk premium is also separate, and hence their betas are also separate. Okay, Namita? So please do ask in case still you have any query in this. Now let us, before going to question number 16, actually in the first session, we have covered question number 4. We have covered question number 4, and at that point of time, I have skipped this part. Just state your observation. Okay. Why? Because at that point of time, we have not done the CAPM. Now we have done the CAPM and we can solve this part as well. Now, students, if you see, this question was around calculating the beta, in which we were given the Krishna Limited prices. correct? And we were also given the market index. So as I have mentioned here that this data is related to security and this data is related to market. Okay. So using both of them, we have calculated the returns of both market and security. So let me highlight it through a different color. So this is the return of security and this is the return of market, correct? That we have calculated. And we were also given the return on government bonds, which are the risk-free rate of returns. And they have asked us that what is your observation? So students, now we have also studied Jensen's alpha and we have also studied capital asset pricing model. So this involves both of them. Now let us see how to evaluate this security. Okay, because they are asking us to state your observation after computing the beta value. So students, now what we have to see is we have to first calculate what is the implicit value of so what is the expected return as per the CAPM. See, we are given two things. We are given the market returns and we are given the security returns. But this security return is the actual return, correct? And this market return is also the actual return. So can we, and we have also calculated beta here. So using beta and market return, I'm just solving the second part here. Let me go back to the black pen. Observation. So 2012, 13, 13, 14 and 14, 15. These are the 3 years in question, correct? So expected return as per CAPM. Expected return as per CAPM, capital asset pricing model, will be risk-free rate of return. This I am putting here, risk-free rate of return plus beta RM minus RF, correct? The risk premium multiplied by beta, which is the risk adjusted premium plus risk-free rate of return. So risk-free rate of return, which is the government bonds for 2013, is given as 6%. 1.897 is beta. RM is what we have already calculated, 10.81 minus the risk-free return is 6%. So this comes as 15.12%. The next one simply 6% plus. So if we see the risk-free rate of return is 666 all across the 3 years. So the next one is 6% plus 1.897. What is the market return for the second year? 16.33 minus 16%. So this comes as 25.60%. And the last year is 6% plus 1.897. The return of market that we have calculated is 16.79 minus 6%. So this comes as 26.47%. So this is the expected return on security for the 3 years. Now we also have the actual return. That also we have calculated of the security 12.24, 32 and 16. 12.24, 32.41 and 16.13%. Now students, if you see, the Jensen's alpha says that you have to compare the expected return and actual return. Now if your expectation is high but actually you are getting low, you should sell it. So in first case, your expectation is to get 15.12, but you are getting as 12.24. That means actually you are not making money what you expect. So that means you should sell this from your portfolio. So our decision for the year 2013 is to sell this. Now in this case, it is 25.6. Expectation is 25.6, but actually the stock is giving us a return of 32.41. That means we will buy it. Correct? The decision is to buy it. If again the 26.47, our expectation is higher and actually we are getting lesser return, that means our decision will be to sell it. Okay, students. So this is one of our pending part that was left for the observation, which I told that. And there was one query also, that what we have to do with the return on government bonds, for which I told that we will cover it once we are done with the CAPM and the Jensen Silva. So now that is the use of the return on government bonds. I hope this concept is clear. Now let us go to the question number 16. Yeah, I hope the question number 16 is now visible. So question number 16 says that, very easy, very simple and very different question. So Sairam is asking, but in this case, loss. Sairam, can you please elaborate which part you are asking? Are you asking for this part only? Are you trying to say that once we sell it, so is there a loss between these two? There is no loss as such, because this is not your purchasing and selling price, correct? This is just we are comparing the expected and actual return. Sairam, please clarify what is the, if that is the question, then it is fine. Otherwise, please elaborate the question once. Okay. So coming to the question number 16, question number 16 is a very good question on arbitrage pricing theory. So this will clear a lot of doubts that if you have. So it says that Mr. Tamarind intends to invest in equity shares of a company. So first of all, the discussion is happening on the investment in an equity share of a company, the value of which depends upon the parameters as mentioned below. So there is a GNP, there is an inflation, there is an interest rate, stock market, industrial production. So there are these different factors that affects the value of an equity share. That means it's not only the market risk, or it's not only the market risk premium, there are a lot of other factors as well, for which there is a different sensitivity altogether. For GNP, the stock is sensitive as good as 1.2 extent. Inflation is its higher sensitive. Interest, it's lower sensitive 1.3. Stock market also it is sensitive, and industrial production it's as same as that is there. Okay, the expected value is this, and the actual value is this. So the expected value is also given, and the actual value is also given. If the interest-free rate of interest, if the risk-free rate of interest is 9.25%, how much is the return of the share under the arbitrage pricing theory? So, see, arbitrage pricing theory says what? As per the arbitrage pricing theory, return on a security is equal to, first of all, we have to take the risk-free return as is, plus beta 1 risk premium of 1, beta 2 risk premium of 2, beta 3 risk premium of 3, and so on, beta n risk premium of n. Now here RF is already given as 9.25%. Now beta 1 is also given 1.2. Now, what is the risk premium? The risk premium of GNP is 0 because the actual and expected, both of them are same. Similarly, for inflation, the beta is 1.75 and 7 minus 5.5 is the risk premium for inflation, plus 1.30 multiplied by 9 minus 7.75. So 9 is the actual return, 7.75 is the expected return, plus 1.70, which is the stock market index, 12 minus 10 plus 1, 7.5 minus 7, which means return on a security, if we calculate this, comes as 17.41 percentage. Okay, students, so this is what the arbitrage pricing theory is. Now, students, if you see in this question, the information that is given to us is in the form of expected value and the actual value in percentage. Now, there can be instances that we are directly given the risk premium, correct? So we will directly use that risk premium and do the calculation. Now let me go back to the question number 4 because Sairam is saying that it is for the question number 4. Page number 15. Yeah. So in this case, okay, now Sairam is saying that if we sell it, then is there a loss? So Sairam, see, loss and gain will be determined that what is your purchase price and what is your selling price, correct? These are not your purchase price and selling price comparison. We can't say, see, this is just the expected return, this is what I expected and this is what actually I am getting. As far as what my expectations are met, I will continue to buy it or I will continue to hold it. If my expectations are met, I will hold it. If I am getting more than expectation, then I will go and buy it, correct? But if I am getting lower than the expectation, then I will sell it. That's the only logic. The loss is a separate thing which will be calculated using your purchase price and selling price of the security and the return that you have earned on that security. Okay. Okay, Sairam, I hope this question is answered. So Namita is asking why we saying difference between expected value. Okay, see Namita, if you see with a flow of quotient, it says that actually I'm able to make higher. Actually, what is the actual value of inflation is 7, but the expected value was 5.5. Correct. What is the risk? What is the see? We are saying that it is a risk premium, right? We say that this symbol is a risk premium of factor 1. This symbol is a risk premium of factor 2. Okay, and this is the risk premium as per factor 3. Now, Namita, please, and Namita and other students, please listen to me very carefully. In the first session, what I told, what is risk? Risk is the deviation of actual return from the expected return. See, on the very first slide, deviation of possible returns. Possible can be in the form of actual if it is a historical data, or if it is a futuristic data, that means with the probability, whatever are the possible returns that are given, correct? From the expected return, correct? I hope, Namita, that answers the question. So hence we have taken the difference and put it as a risk premium to calculate the return. Now Jitendra is asking required return as per CAPM. Jitendra, are you asking in this question? This is for the, again, I think if you're referring the question number 4, so in that we have calculated the required return as per CAPM, and that is the expected return itself. Required return as per CAPM means the risk-free rate of return plus the market premium multiplied by beta, which is the risk-adjusted return. Sairam is asking, why do we doing arbitrage pricing theory? So Sairam, see, all these theories are based on certain situations. Now, arbitrage pricing theory says that why we only need to consider one risk factor, which is market return or the market risk. There are a lot of other risks, correct? There are a lot of other risks. For example, GNP, for example, inflation, that will also impact your returns, interest rate, stock market index, everything will impact your returns. So why don't you take into consideration those factors as well? Okay, Sairam. So basically these are different thought processes that have come up in the different theories, which is also quite logical as well. Only depending your return on the market return would not be great, because you have other factors in the economy operating as well. So you have to give them also certain weights and do the calculation accordingly. Okay, students. Now let us go to the next part. Question number 16 is done. Now again I am coming back to the first slide. See, in the first slide, while we started our discussion on portfolio management, we said that we have to answer 3 questions, or our discussion will be mainly around 3 questions. First of all, which security, what would be the amount, and third one is evaluation of a portfolio. So which security we have done, and now evaluation of a portfolio also we have done. Sharpe's ratio, Turner's ratio, and Jensen's alpha. And during the course of the questions, we have also studied it. Now comes the answer, what amount? Okay, what amount? See, students, now in this answering what amount, there can be 2 situations. Okay, sorry. Question number 16 is done. Yeah. So now let us come to the part of what amount, or I can say that what proportion what is the proportion or what is the amount that we need to invest in these securities, correct? Which is the second part of our initial discussion in the second step. Now students, if you see in this also we can have 2 situations. Okay, we can have 2 situations, again 2 securities or more than 2 securities. Okay, so first let me take more than 2 securities, and then we will also come to 2 securities. Okay, so whenever we talk about more than 2 securities and what is the proportion, we will follow the Sharpe's index model, or we can say that this is the optimal portfolio given by Sharpe. Now students, I would request for both these things, while going for the formulas or derivations or a lot of other things, see those, I can definitely tell you what is the logic behind the formula, right? But the derivations, the understanding of the formulas definitely involves a lot of things such as differentiation, all those things. So that derivation we would not be covering, because that is beyond the scope, time and effort. Let us just concentrate what this theory has concluded and apply that conclusion over the set of data. That is what our expectation is. Okay. Now Shar's index model is already, so basically all that process of till conclusion is already done by Shar himself. Now what he says is, what the theory says is that we have to perform a step of 4-5 steps. So the first step is we have to calculate the Turner ratio. Now we are trying to answer that if we are given a set of 10 securities, out of those 10 securities, which security to pick and what amount to invest on in those securities. Correct? This is what we are trying to answer. So first they say that calculate the Turner ratio, which is nothing but the return on a security minus risk-free rate of return divided by the beta of that security. Okay, this is what the Turner ratio is. Please note, this is not a standard deviation. This is a beta. Okay, hence it is a Turner ratio. If we divided it by the standard deviation, then it becomes the Sharpe's ratio in the evaluation technique. Correct? Then second part, it says that rank basis highest and lowest. Now after you have calculated this, then you have to rank basis the highest value of Turner to the lowest value of Turner. Okay, because definitely the preference will be given to the security having the highest Turner's ratio, right? That means we will go from the highest to lowest. Then third part says calculate value of C. Now C is a calculation that has a very complex formula. Okay, we don't have any other option apart from remembering this. Every time we cannot remember it through the derivation or through any other thing. So it says that you take the market variance, and in that market variance take a summation of all the values basis the Turner ratio Ri minus Rf divided by residual variance multiplied by beta of I, and this whole should be divided by 1 plus. So students, please don't worry, we will go to the each and every step how these steps are to be solved. We will do a one practical example on this. I is equal to 1 to n, and here also you have to take beta I square divided by ei square. Okay, this is what the total formula is. So once C comes, once the C value is put for all the 6 securities after ranking them, then the next step is compute the cutoff point where C is highest. So once you have ranked it, then you have calculated the C value, take the cutoff point where C is highest, then you select all the securities above that C. That again we will study with the help of a question. Okay. And after doing that, compute the cutoff point where C is the highest. After doing that, we have to calculate another step, which is calculate Z. So these are some standard terms and notations, hence we are using that. So ZI, wherever I we are using, that means that is for a particular security. So for all the securities that are selected for basis this C, we will calculate Z. ZI is beta I divided by variance of systematic, unsystematic variance, return on I minus Rf divided by Bi minus C star. So C star is that C cutoff point basically. So this is called as C star. After the Zi is calculated, for all the securities which are above the cutoff point, all the securities, then the weight is Z divided by the total Z, sum of Z's. This we will study, or this we will go through as per the question. So finally, using Z, we will find out the weights. By dividing the Z value of a security with the sum of all the securities Z value. This is where our calculation will end. So Namita is asking, sir, what does this Trenner formula says? Okay, so Namita, in the previous session, we have discussed about Trenner's ratio and Sharpe's ratio. Okay, so Sharpe's ratio, we have studied that it is the excess risk premium per 1 unit of standard deviation, correct? Because it is divided by standard deviation. And Trenner is excess risk divided by the beta. So that means for 1 unit of beta, how much excess premium are we getting? Excess return are we getting? See. Anyways, for this Sharpe's and Trenner's ratio, we will again be discussing in detail today through the securities market line and capital market line, Namita. So Namita, I will again clarify the Trenner and Sharpe's ratio in detail, because there we have a use there. Now Namita is asking, in C formula, we should divide by beta. As you said that we need to use Trenner ratio. No. See this. So here, this division is not for the Trenner. So we are not applying here Trenner ratio, Namita. That's not the case. See, Trenner ratio is calculated only in step 1 to rank the securities. In calculation, they are using the Trenner's, the Sharpe's index model is using the excess return divided by variance. Okay, the unsystematic variance they are using. I think, see students, if you go through these steps, you will not be able to dissect it properly. Let us understand it from the question better. Now, just read this question very carefully and we will go with the respective steps by steps in this. Yeah. So, question number 17 says that Ramesh wants to invest in stock market. He has got the following information about the individual securities. There are 6 individual securities, A, B, C, D, E, F. The expected return, which is RI, is given. Beta is also given. And the unsystematic variance, which is the residual variance, is also given. Okay. Market index variance is 10%. So they are saying that market variance, not market standard deviation, this is market variance, is 10%. And the risk-free rate is 7%. What should be the optimum portfolio assuming no short sales? They are saying that what is the optimum portfolio using this information you have to calculate. So this is more than 2 securities, because 2 securities, as I told you, that we will cover it later. So more than two securities, we will apply the Sharpe's index model, okay, to calculate the optimum portfolio. Now, what is the first step? The first step is to calculate the excess return of a security over beta. So let us plot the data that is given: security A, B, C, G, E, and F. The return is given as how much? 15, 12, 10, 9, 8, and 14. This is what the return is given to us. And the beta is also given for the respective securities: 1.5, 2, 2.5, 1, 1.2, and 1.5. This is what the beta is also given to us, correct? Now, the next step is to calculate Ri minus Rf. Rf is what? The risk-free rate of return is 7%. So 15 minus 7, 8. 12 minus 7, 5. 10 minus 7, 3. 9 minus 7, 2. 8 minus 7, 1. 14 minus 7, 7. 8, 5, 3, 2, 1, 7. See, students, till now, if you see what is the best security in this, which is the security which is giving you the highest return over the risk-free rate, because the risk-free rate every security will give you. But what is the excess return? Definitely A is giving you the excess return, correct? But we have to see it in relation to beta also, because if we don't consider beta, that means we are ignoring the risk element. So next step is Ri minus Rf divided by beta. Okay, so that means 8 divided by 1.5. 8 divided by 1.5, 8.5.33. Then 5 divided by 2, 2.5. Then 1.2, 2, 0.83. Then comes 4.67, which is 7 divided by 1.5. Okay. So this part is also clear. Till now we have done the first step, which is the calculation of this. This is done. Now let us go to the ranking from highest to lowest. So now we are doing the ranking. So students, if you see within this, how is the ranking? So where is the highest Ri minus Rf divided by beta, which is this. So first ranking is this, because 5.33 is highest. Second ranking is F, 4.67. Third ranking is B, 2.5. Fourth ranking is D, which is 2. This is fourth. Fifth ranking is C, and sixth ranking is E. Perfect. Pradeep, thank you for answering. A is having the highest ranking. Okay. Now we have plotted all the rankings here. Okay. We have plotted all the rankings here. Now let us rewrite in terms of the ranking. Let us write in terms of the ranking. So security, let us organize in terms of ranking. So first of all, A was there, then F had the second ranking, third ranking was with B, then D, then C, and last one was E. That is how the ranking was there. Now let us again plot. Now if you see, we have to now go to the calculation of C. Okay, so C involves a lot of calculations here. So we will plot one by one, column by column, first for all the numerators and then for all the denominator calculation. So for numerator, the first thing is required is Ri minus Rf, correct? So for A, we have already calculated in the above table. I'm just copying it from there. But in a sequence, right? In A has to be copied in front of A, F has to be copied in front of F. So it was 8, 7. Third one is B. So B is 5. Then fourth one is D, which is 2. Then C is having 3 and then 1. 8, 7, 5, 2, 3, 1. Now students, if you see, automatically the Ria minus Rf is arranged like this thing, and we have to put the beta also here. So the beta is how much for the respective security? 1.5. 1.5. B beta is 2, D beta is 1, C's beta is 2.5, and E's beta is 1.2. Residual variance is also given to us. Residual variance is given again in the question itself. It is given. We will copy in the right sequence. For A, it is given as 40. B, it is given as 30. C is given as 20. D is given as 10. A, F, B, D, C. Sorry. C is given as 30 and E is given as 20. So for A it is 40, F it is 30, B it is 20, D it is 10, C it is 30, and E it is 20. So we have copied it in the same sequence of the securities that we have put. Now what is the first part of C? If you go to C, so this standard deviation of market and standard deviation of market will remain same, which is the variance of market, and variance of market is same, which is 10 and 10. So there is no need to calculate it. Now the calculation part will be for this and this, correct? So let us calculate the first part, Ri minus Rf divided by standard deviation, variance of unsystematic multiplied by beta. So what we are going to do is Ri minus Rf divided by residual variance multiplied by beta. This is what we are going to calculate. So Ri minus Rf is already, we have 8 multiplied by beta of 1.5, this whole divided by 40, correct? Then this we have as 7 multiplied by 1.5 divided by 30. 5 multiplied by 2 divided by 20. 2 multiplied by 1 divided by 10. 3 multiplied by 2.5 divided by 30. So this comes as 8 into 1.5 divided by 40, 0.30. Seven into 1.5 divided by 30 comes as 0.35. 5 into 2 divided by 20 comes as 0.5. 2 multiplied by 1 divided by 10 comes out to be 0.2. Again, I'm just projecting. Then for security C, it is 3 into 2.5. 3 divided by 30 into 2.5 comes as 0.25. And this comes as 0.06. So this also is calculated 1 into 1.2 divided by 20. 0.06. Okay, students. So till now we have calculated one part of the numerator which is used in the calculation of C. But if you see now, coming back to the C calculation, we have to use a summation of, right? We have to use a summation of. So as of now, these values are the independent values. Please note these values are the independent values. Now if this entire thing I'm putting here as a summation of Ri minus Rf divided by residual variance and beta. Okay. So what we have to do is here, first one it will be 0.30. Second one will be 0.30 plus 0.35. We have to do the running summation, correct? For A is there, then for F it will be A plus F. So 0.3 plus 0.35 comes as 0.65. Then for B it will be A plus B plus F, so which is 0.65, which is A plus F plus 0.5, which is coming as 1.15. Then 1.15 plus 0.2, which is 1.35. 1.35 plus 0.25, which is 1.60. 1.60 plus 0.06, 1.66. Okay, so this is on a running total. We have done the summation for the respective security. Now let us go to the denominator part, because in the numerator part we have computed the everything, except now we have to just multiply it with the standard deviation of Markovitz square, which is variance. Now in the denominator we have to calculate beta square divided by residual variance square, which is given like here. Beta square divided by standard deviation of Markovitz square. So beta also we are given 1.5 square divided by 40. So 1.5 multiplied by 1.5 divided by 40. It comes as 0.056. Then 0.075. 0.20. For D it is 0.10. Then C is 0.208, and last one it is 0.072. So this is nothing but for the respective security we have taken the beta square divided it by the standard deviation, the unsystematic risk variance. And then again in the last column we have to take the summation of beta I square divided by this divided by standard deviation of EI square. No, Namita, so what we are doing here is, first of all, we have to calculate this value 0.30, 0.35, 0.5 for the respective security. Correct? What is the this value for respective security, and then in next column we are doing the summation of all the securities above and including that security. Okay, hence to explain you step by step I have put in different columns. Okay, now here we have to do the summation 0.056, then next one is 0.056 plus 0.075. So this comes out to be 0.131. Here it is 0.131 plus 0.20, which is 0.331. Okay. Then next is 0.431. Then next is 0.639 and just taking the summation, the running summation 0.711. So now the piecemeal calculation have been done for numerator and denominator, and now we have to finally calculate the C. I hope till here the process is clear. This is what the model is asking us to calculate. Now let me put here security. I'm just again putting the same reference A, F, B, D, C and E. This is security. Now CI is equal to standard deviation of market square summation of Ri minus Rf divided by standard deviation of EI variance multiplied by beta, and this we are dividing it by 1 plus standard deviation of market square summation of beta square divided by market unsystematic risk. Not market, but for the security. Okay, this is what simply I have just copied the formula there. Okay, this is the formula. Okay, because of the space constraint, this is what I just wanted to make it. So now let us calculate the C value. Now students, if you see for the C value, for the numerator, we have market variance as 0.10 multiplied by, what is the summation? First value 0.30. This whole divided by 1 plus 0.056 into 10. Sorry. Into 0.10. Okay, students, this is what the value of C is. If you see as per the above formula, 1 plus standard deviation of market square multiplying it with the second term. So from where I have taken this 1, 0.30 is coming from 1. Okay, similarly for 0.056 is coming from here in the denominator, 0.056. Okay, similarly if we calculate this, so this comes as 0.056 multiplied by 0.1 plus 1. This is the denominator, and numerator if we solve, we are given the market variance is 10 only. Just a second. 0.056 is the denominator. So the beta square and the standard deviation, sorry, the unsystematic risk, which is the residual variance, square is coming out to be 0.056. So students, please note in this case, what the formula says is, and one mistake which I also did is we don't have to use the decimals here. Okay. So always put it as a absolute value here. Let me correct this. Okay. So this is actually the absolute value itself, not the decimal. Just make a note of it here as well. Note is an absolute value and not in decimal or percentages. Okay. So exactly 10 we will have to put there. So now if we do 0.3 into 10, so let me first solve the denominator. 0.056 into 10 plus 1, it comes as 1.56. 0.3 into 10 divided by this comes as 1.923. Okay, students. So this is what I was trying to say. Now for f, 10 multiplied by 0.65 divided by 1 plus 10 multiplied by 0.131. Now here also, from where these values are coming is, this I am putting as second reference, and this is coming from here, second, and the denominator part is coming from here, 0.131. This is 0.131. Okay. This is, if we solve this, it comes out as 2.814. So 0.131 multiplied by 10, 2.31, and 6.5 divided by this. So this comes as 2.814. Now for B security, it will be 10 multiplied by 1.15 divided by 1 plus 10 multiplied by 0.331. This again is coming from third reference, which is 1.15, this third reference, and the denominator is 0.331. Okay. If we solve this again, 0.331 multiplied by 10 plus 1, 4.1, 1.15 into 10 divided by this, so which comes as 2.668. Okay, students. And now simply if we keep on calculating the other parts, okay. Now D part is what? 10 multiplied by, for D part, the summation numerator is 1.35 divided by 1 plus 10 multiplied by denominator summation is 0.431. So this comes as 2.542. Then C part, it is 10 multiplied by 1.6, 1 plus 10 multiplied by 0.639, which is equal to 2.165. Okay, and last part, which is 10 multiplied by 1.66 divided by 1 plus 10 multiplied by 0.711 is equal to 2.047. Now, if we see this 1.35 comes from the fourth reference, which is this. And this is also coming in the denominator. 1.60 goes in the fifth reference and 1.66 goes in the sixth reference. So this is the fifth reference and 1.66 is in the sixth reference. Okay. So till now we have calculated the value of C, which are these. Now Namita is asking what problem arises with decimal. So Namita, what happens is that this formula is built in such a manner that if you use decimal or percentages, correct? See, what we are trying to calculate is value of C. Now value of C is actually dependent on what is the absolute variation in market, which is the 10%, which is the absolute 10. So basically this 2.814 which has come here is also in absolute terms itself. Okay, so that is how the formula is built in. If we use decimal, then it would be not right. Okay, students, so till now we have calculated the value of C. Now we have to calculate the cutoff point. If you see which is the highest C in this, the highest C is actually this. As C is highest. So this value becomes C star. Okay. This value becomes C star. Now, what we have to do is, since this is the cutoff point, all the securities above this point, including this, will be included in our portfolio as per the theory again. So both A and F finally are the two securities out of these 6 securities that we are going to select. So what we can write is A and F are two securities to be selected as per the Sharpe's optimum portfolio, as C star is highest for security F. Okay. Now we have to find the proportion. For finding proportion, we have to calculate Z. Now calculation of Z. Now Z for A and Z for F. So Z for A, so Z formula what we have seen is Z is equal to beta unsystematic risk variance, this whole multiplied by Ri minus Rf divided by beta I minus C star. Correct? So for ZA, what is the beta of ZA? 1.5, residual variance is 40, correct? This whole multiplied by Ri minus Rf divided by beta is in the first Trenner ratio. This is the Trenner ratio that we have already calculated, 5.33, and star is 2.814. So this 2.814 is our C star, correct? 5.33 is the Trenner ratio that we have already calculated, and 1.5 divided by 40 is what? The beta and standard deviation unsystematic risk variance is there. So if we solve this, so ZA comes as 0.09435. This is what ZA is. Now coming to ZF. So ZF is 1.5 is the beta, and variance on unsystematic risk is 30. 4.67 minus 4.67 is the Trenner ratio, which is our return of security minus return risk-free return divided by the beta, correct? 2.814, 0.0928. Okay, so now we have calculated ZA and ZF, correct? With this, we will calculate the weights. So the weights, that means XA is equal to ZA divided by ZA plus ZF, which is equal to ZA is how much? 0.9435, 0.09435 divided by 0.09435 plus 0.0928, which comes out to be 50.41%. For XB, it is ZF divided by ZA plus ZF, which is 0.0928. Correct? ZF is 0.0928, 0.09435 plus 0.0928. This comes out to be 49.59%. Now finally, these are the two percentages which are adding to 100 percentages is what we have to invest in securities. So security A and security F. A, you have to invest how much? 50.41%. F, you have to invest how much? 49.59%. These are the two investments that can be done, and this total is 100. So this is our optimum portfolio where the return would be highest and the risk would be lowest amongst all the combinations. Okay. Jitendra is asking, if all portfolio evaluation method different rank to script by portfolio, then how to selection criteria? Jitendra, I think you are I'm not able to understand, Jitendra, what you're trying to say. If you're saying if all portfolio evaluation method different rank to script by portfolio, then how to selection criteria? Jitendra, can you please elaborate the question? Okay, so let me again come back to this process and reiterate it. So we have studied that in case of a Sharpe's index model, how to calculate the optimum portfolio. First of all, we have to calculate the Trenner's ratio. Trenner's ratio is Ri minus Rf divided by beta. Then we have to rank basis the highest to lowest. We have to, against that ranking, we have to calculate the value of C. Value of C is given by this formula, which is standard deviation of market square multiplied by the summation of these terms that are mentioned after the summation and divided out by 1 plus the standard deviation of market square multiplied by beta square divided by variance, unsystematic risk variance, correct? And in this, we have noted that always we have to keep standard deviation of market square in absolute. If it is 10%, we have to take the value as 10. If it is 12%, we have to take the value as 12, not as a percentage or not as a decimal. We have to take it as a whole number. Then we have to calculate the cutoff point C star. Once it is done, we will calculate the Z value. So Z value will help us in calculating the final weights. So Z value is given by beta divided by unsystematic variance, and that's how we can calculate the weights. So Pradeep, I mean practically whether it, see for the share market, definitely we know that how the index calculation happens, right, and how the market is constituted. So the top stocks will be taken, and for them the price movements will be studied, and then hence those top indices, the market capitalization will form the BSE or NSE, correct? But since this is one of the theory or one of the model that is given to calculate if you as a portfolio manager are given these 6 securities, then how are you going to invest? Then this is specifically applicable to that kind of a situation only. So really, I'm not very sure whether this is applicable for practical share market or not. Because see, we started this question with 6 securities, right, Pradeep? Now, share market is not these 6 securities. There are a lot of securities. So first, how to select 6 securities from those securities is also a question, correct? So hence I'm saying that these studies are formulated on some specific underlying cases or on some underlying situations. So I'm not too sure how far it is practically applicable to the share market. Okay, Pradeep. Jitendra, I may request you to please elaborate your question because I'm not able to get what exactly you are asking. Namita, the question is, sir, market actually can move in any direction. So how our portfolio will work? Actually, it is just calculation in paper. So Namita, I think you what you are saying is right only. See, what happens is definitely you will take this calculation and do the initial investment basis the calculation, right? But as and when the market changes, as I said in the previous session as well, all the parameters will get calculated in every second. For example, the return, the standard deviation, risk, residual variance, beta, all these things are not constant. These keeps on changing. These are very variable in nature. So definitely, if you see in actual practical life, there would be some kind of good models, algorithms that are there, which is used in some of the softwares that will keep on doing this calculation. Because see, as a portfolio manager, you will not do these calculations, right? These calculations will be ready-madely available to you. You have to make the decisions basis that, correct? So this is what I believe. Although practically I don't have any experience in that. Are these calculations apply on all securities? Yes, Namita. These calculations we have to apply on all securities to see that which security is the best fit for the purpose. Okay. Now let us go back to the starting point of this part of the discussion, which is what amount and what proportion. So in this, I said that first let's cover more than 2 securities, which we have already covered through the Sharpe's optimum portfolio. This is it on the Sharpe's optimum portfolio. Now let's come back to the 2 securities. Okay, now optimum portfolio, or I can say this is a minimum variance portfolio. We have to put it like this. So just a second. Yeah. So what I'm saying that this is the minimum variance portfolio in case of two securities. Okay. Now, on minimum variance portfolios for two securities, there is already, again, as per the ready-made formula or the ready-made conclusion that Sharp index model gives us, we just apply that conclusion and calculate the securities as well as the amounts to be invested. Simply for minimum variance portfolio also we have one formula, okay, but that formula is actually derived and the derivation also we can do, but beyond time and efforts and all those things, and definitely no one is going to ask that derivation in examination, so hence we are skipping that, but directionally I will tell you how that formula is derived. Okay, so let us see what the formula is first, because that will unnecessarily involve time and efforts. And let us see what the formula is and what does it say. So the minimum variance portfolio says that if you have to calculate the weight of security 1, okay, weight of security 1 is equal to standard deviation of security 2 square, which is the variance, minus R, which is correlation coefficient of 1 and 2, standard deviation of 1, standard deviation of 2, divided by standard deviation of 1 square, which is the security for which you are going to calculate the weight. Okay, so weight 1 means, let's say 1 and 2, this is security 1 and this is security 2. Okay, plus standard deviation of 2 square minus 2R12, standard deviation of 1 and standard deviation of 2. This is what the formula is. And using the relationship of R and standard deviation 2, we can use the covariance, correct? So, or this is the second part, so which is the, for the second security variance we will take minus covariance between 1 and 2, because this term, if you see, this is covariance, right? R12 standard deviation 1 of standard deviation 2 is actually a covariance. This is what we have put, okay, divided by standard deviation of 1 plus standard deviation of 2 square. So basically on both of them are variances, minus 2 covariance of 1 and 2. This is also weight 1, and simply weight for the second will be 1 minus weight 1. Okay, so with this you can easily calculate the weight 1 and weight 2. Now, how this formula is derived, let me just spend 5 minutes on that. See, students, we know that for two securities, the risk is calculated using the Markovitz portfolio theory, in which the formula is given as, so the risk of portfolio, which is variance, I'm saying, as of now we are speaking in terms of variance, standard deviation of 1 square, weight 1 square, plus standard deviation of second security square, which is the variance of second security, weight 2 square, plus 2 R12, standard deviation 1, standard deviation 2, W1, W2. This is what we have already studied. So this R12 is also, we have to multiply in this formula. Now if we replace W2 by 1 minus W1 in this, okay, so can we rewrite this as plus 1 minus W1 whole square plus 2 R12 standard deviation 1, standard deviation 2, W1 and 1 minus W2. sorry, 1 minus W, 1. Okay. So this is the formula that I have rewritten. Student, please don't note this, or please don't prepare for this, because this is just a derivation of this formula. That's all. Now everything is in W1, 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 W1. So if you see in this equation, now W1 is our variable. Okay, and rest all things are constant. Correct? So because this is already constant, this is also constant, this will also be constant, because we're trying to find out weight, and hence weight is variable. Now if you open all this equation, multiply this with this and multiply all these things, and then do the differentiation. Okay, then do the differentiation of this entire equation. Okay, then you will get this formula. Okay, students. So this is so basically this you have to put as is equal to 0, because we are saying for a minimum variance, we say that standard deviation of that particular portfolio will be 0, is equal to, you will have to do the differentiation here, and then taking W on one side and rest all things on other side, you will get this formula. I'm not covering up that differentiation and that derivation in this session. Okay, but this is just to give you a directional update that how this has been derived. That's all. But this definitely we will have to remember. Now, I think there was a query in the previous session by Naveen on the question number 7 part 3. So question number 7 part 3 actually is related to this only. Okay, so this is the question number 7 from the study material. Let us just read out this first, and let us just discuss the solution once, because it's just a simple formula application. That's all. Formula is the same that we have seen just now. So it says that question number 7 part 3, I'm reading on the entire question first. An investor has decided to invest ₹1 lakh in the shares of two companies, namely ABC and XYZ. The projections of returns from the shares of two companies along with their probabilities are all follows. So there are two companies, ABC and XYZ, along with their probabilities, percentage returns are given. You're required to comment on risk and return of investment in individual shares. So first of all, they're asking us to calculate the risk and return. So return we can just simply calculate multiplying with the probabilities, correct? Because it is a futuristic data, we can multiply the individual return with the probability to arrive at a weighted average return, which is called as the expected return. And the risk also we can calculate simply using the expected return and the probable return, correct? So both return and risk we have already studied using the formulas, and we can calculate. Second part says that compare the risk and return of these two shares with a portfolio of these shares in equal proportions. Now they are saying that make a portfolio of ABC and XYZ in which you divide the portfolio into 50-50%. So for that also you have to calculate the risk of the portfolio, which is again using the MPT, Markovitz portfolio theory, correct? Because here you can't apply the Sharpe's index model. Why? Because you don't have any residual variance. For calculating the portfolio variance using Sharpe's index model, we need to have residual variance, which is not there. So we have to apply portfolio, the modern portfolio theory, MPT, correct? Second part is also done because you have to calculate the portfolio risk and portfolio return. First is security risk, security return. Second is portfolio risk, portfolio return. That is also done. Now, third point, it is asking us to calculate the proportion of each of the above shares to formulate a minimum risk portfolio. Now, these are two securities that are there. No need to go to the Sharpe's index model, because that applies to more than two securities, and that have a very complex thing, because in that you need the residual variance, beta, all those things. In this, because this we are going to calculate the minimum risk portfolio, so we can use this formula that we have just discussed now. Okay, let us go to the solution ones and discuss the solution ones. See, now solution 7.1, first of all we are calculating the security, which is ABC and XYZ return as well as risk. So in the first table, this is calculated as return 12.55 and 12.1, and in the second table the risk is calculated, which is finally denoted as 12.95 and 11.27. Okay. Then in the second part, to calculate the portfolio risk and portfolio return, we are using the modern portfolio theory, that is just applying the simple formula. And then the last part, which is the constructing the minimum risk portfolio, the same two formulas are there, which we have just discussed now. Using these formulas, we can arrive at the percentages. But again, I'm saying don't go into the derivation part, because that is one thing which is definitely not expected. We have to just apply this concept to see what it is. Okay. If you have to understand and build logic on derivation as well, I have told you that it is coming from this formula only, which is the modern portfolio theory, wherein you replace weight 2 with 1 minus weight 1. This changes the equation. Left hand side of the equation you equate with 0, and then you differentiate the equation with respect to W1. Okay. Differentiate the equation with respect to W1. You will get the answer. Okay. Okay, students. So I think Naveen, this is clear. And if there is any other doubt still left, please, I am very happy to answer. Please do ask them. Now coming to the question number 18. Again, a very good and very logical question. Okay. So we will read out this question. Coming to question number 18. So yeah, on question number 18, as I was saying, is equity of ABC Limited is 500 crores and its debt is 290 crores. So let us try to first see the information that is given. Equity is given as how much? 500 crores. And debt is given as 290 crores. So the total is how much? 790 crores. Okay, students. Okay, before this, actually there is some theoretical part of the chapter as well. For example, active portfolio strategies, passive portfolio strategies. I would request that basis this discussion, definitely you'll be able to understand those things. So please go through that, and you can ask the query in case you have any specific queries in that. On the theoretical part, I'm saying. But as far as the practical understandability is concerned, that will come through these questions that we're trying to solve in the class. And even from this, we can definitely differ what we are trying to understand in the theory as well. Okay, so equity is given as 500 and debt is given as 290. Now there are two divisions. So there are two divisions. One is the printer division. And they are saying that it is around 64% of the total business. Okay, the total investment in printer division is 64%, has an asset beta of 1.55. So basically, if you see, they are trying to, so here till now the beta is what we have studied for a particular security. Now if you see, beta is attributed to anything, whether it is a equity, whether it is a debt, whether it is an asset, whether it is a specific investment. So beta can be of anything, because what is beta? See, beta is just a sensitivity of returns of a security in relation to that of a market. Correct? Now here is what? This is sensitivity of that particular asset in relation to something. This is what this asset beta is. Okay? And the balance value is applied on spares and consumables division, which is having an asset beta of 1.4. Spares and consumables, there is another division which have a beta of 1.4 and the balance value is 36%. Because if 64% is in printer division, 36% is in spares and consumables. Now, first part they are asking us to and also it is given that debt beta is 0.28. This is 0.28. So this is what they are asking us to calculate, the equity beta in the first part. Now, students, if you see that if we purely go with the concept, right? So definitely following this the balance sheet approach, correct? All the assets are definitely equal to the liability, right? Because these belong to the same company. Similarly, the beta, the weighted average beta of the assets has to be equal to the weighted average beta of liability, correct? So applying the same logic, what we can say is that solution so here I'm saying equity and liability, okay, and here I'm saying assets. So weighted average of equity and liability, because students, if you see, there is one more logic to it. If you see that the assets beta is resulting into some x number, ideally the amount of investment or let's say the amount of sources of funds, the equity and liability also have to behave in the same manner, right? Then only the entire company's beta will be consistent. Weighted average of assets beta, correct? Now, first of all, let us calculate the weighted average of asset beta. We have given that there are two divisions. One is printer division. So weight is how much? 64%. And beta is how much? 1.55. So the weighted beta is how much? 1.55 multiplied by 64. It comes as so 1.55 multiplied by 0.64, 0.992. Okay, students. So this is what the printer division beta is, and second one is spares and consumables. So the weight is 36% here, and 1.40 is the beta. 1.4 multiplied by 0.36, it comes as 0.504 plus 0.992, it comes out to be 1.496. Okay, so this is what the overall asset beta is. Now, we also know that 1.496 is equal to, now what we are assuming is let equity beta be x, because we have to form this equation. So we are assuming it to be x. So x multiplied by, now can you tell me what is the proportion of equity in the overall investment? Calculation of proportion of equity and debt. Can we calculate this? So equity is how much? Divided by 790, correct? Because 500 is equity and 290 is debt, so 500 by 790, this comes out to be 63.3%, and debt is 290 divided by 790. 36.70%. Okay. So basically equity is 63.30 and debt is 36.7%. So 63.30% for equity plus debt beta is how much? 0.28 multiplied by 36.70%. Okay, so if we solve this, then x is equal to, so this will be 0.28 multiplied by 36.67%, 1.496 minus this, 2.20. That means equity beta is equal to 2.2 as per the current debt mix and the current investment mix. Okay, so we expect that equity beta should be 2.2 because we have invested in such assets for which we are getting a composite beta of 1.496. Since debt comes as a lower beta, now someone of you might ask that why there is a beta for debt at all. Ideally the debt beta should be 0, but what we can understand is the risk-free security beta is 0 because that is not related to the market. But still the debt can be issued in the form of, let's say, the bonds and all. So that market price will, or the return will still be dependent on market. So hence there is some element of beta which is 0.28 that is there. So if you see what is the beta is 0.28, correct, on debt. So it's slightly lesser. That means the equity beta should be higher to compensate for the overall investment. Now let us go to the second part of the question. I hope this question is clear. Second part says that ascertain equity beta. Now again he is giving you, the question is giving you the second situation that you have to ascertain the equity beta if ABC Limited decides to change its debt equity position by raising further debt and buying back of equity. So what composition that they are putting is that they are going to issue further debt. That means from 290 the value of debt is going to go up and the equity shares are going to go down. See, ideally equity shares will go down only in case of the buying back of the security, buying back of the equity, correct? Where the company will buy back the equity and pay the money to the investors. So this is that kind of a situation. It is mentioned buying back of equity, and it will finally result into a debt equity of 1.5. This is the target debt equity ratio that they have to maintain is 1.5. Okay, so but again what they are trying to say is that still the overall investment or the overall portfolio will still be of 790 crores. 790 crores is not changing. 790 crores is constant, but it's just that the mix between debt and equity is going to change as per the second point number. So let us go to the second point now. So second point, they are saying that debt equity ratio is 1.5. That means if debt is 1.5, then equity is 1 and the total should be 2.5, correct? Is what I'm trying to say. If debt equity ratio is 1.5, that means that if total is 2.5, out of that 1.5 is debt and 1 is equity. Now what is the total capital? Is 790. That is already given in question as per the initial amount 500 and 290, correct? So if total capital is 790 and 2.5 we can equate to 790. So 1 is what? 790 divided by 2.5. So 790 divided by 2.5 comes as 316 and 1.5 will be this, correct? 790 divided by 2.5 multiplied by 1.5. 790 divided by 2.5 multiplied by 1.5, which comes as 474. Now if we total this, 316 plus 474 should be equal to 790. So this is the revised composition on equity. And this is the revised composition on debt. And hence the overall capital structure have changed. Now let us see what is the change. So incremental debt, because the situation that is given to us in the question is that we are issuing further debt and reducing our equity. So incremental debt is how much? Earlier it was 290, now it is 474. So 474 minus 290 is coming out to be 184 crores. So the rupees 184 crores is the incremental debt issued and the equity share capital bought back. The buyback of equity share capital is 184. Okay, now we have analyzed the situation that is given in the question. Now let us see what is the requirement in the question. The requirement is to calculate the equity beta, correct? Now we have equated the debt equity ratio as 1.5, restructured the debt and equity. Now we have to calculate the equity beta, but they are saying that assume that this is in relation to the second part only, correct? Assume that the present debt beta is 0.45. Now this is something other than what we were told earlier, because for the earlier part the general information is given that debt beta you can assume 0.28, but here they are saying for specifically for this part you assume debt beta is 0.45 and any other further debt raised will have a beta of 0.5. So we will go with what question is saying, correct? Now again we will calculation of, this is the second point, main answer now, equity beta. Okay, now if we see, okay, I'm putting it here. First of all, you have to put the source, then we have to put the investment, what is the current amount of investment, what is the beta and weight, and then finally weighted beta. Let us see what all items are there. So first of all, there is equity, there is debt 1, and then there is debt 2. Okay, so there is equity, debt 1 and debt 2. Debt 1 is the existing debt and this is the new debt. Okay, so existing debt. Okay, now let us go to the investment part first. So equity is reduced to 316. Now in the revised 790, the reduced equity is 316. And 184 is the incremental and 290 was the earlier debt. So 290 is the debt 1, correct? And 184 is the incremental amount. This total comes out to 790. Beta, we can equity for assume X as of now. Let equity beta be X. Okay. And for det 1, now students please note here, det 1 we cannot take 0.28. 0.28 was a general one. Now for second part we have to take 0.45 as for det 1, which is the existing debt, and the revised debt that we are getting is at 0.50. Sorry. Okay. Now, can we, using this investment amounts, can we calculate the weights? Yes. So 316 divided by 790 comes out as 40%. So revised equity is 40%. And 290 divided by 790, 290 divided by 790 comes out to be 36.7%. Okay, and last one, which is 184 divided by 790 multiplied by 100, it comes as 23.3%. Okay, students. So we have calculated the weights using investment. Beta is also already there. Now it is just a simple multiplication. So this will become as 0.4x. Then this will be 0.165. This is 0.117. Just multiplying beta with the respective weights. And now finally we can take it as 0.4x plus 0.282. This is what we have calculated. On the sources of the fund side, what is the beta coming out to be? Now we can easily equate to the asset beta, the original asset beta that was given in the general part of the question. So that we have already calculated in part 1, which is coming out to be 1.496 is equal to 0.282 plus 0.4x. Okay, students. Now in this, we can easily find out the value of x is coming out to be 3.035. So that means, now students, please note, this is the main part. So the first part, we said that beta of equity is how much? 2.2. The second part, the expected beta on equity is how much, is getting increased by 3.305. Now if it is getting increased, now what would be the reason for this to increase? Now I would like to hear some good answers on this. Please do answer. What would be the reason of increase in this equity beta from one part to another part? If you can quickly analyze and put some of the reasons. Because the last part is related to that only, that whether the new equity beta justifies the increase in the value of equity or not. Please students, try to attempt this question that I am asking, that why there is an increase in beta. What is the change element that has happened because of the increase has happened in beta? Is it? So I think, so let the answers come. Yes. So Naveen is saying leverage increases financial risk on equity holders. That's right, Naveen. And hence now, can you tell me that which kind of risk is financial risk? Financial risk is a systematic risk or unsystematic risk? That we've already studied. Financial risk is an unsystematic risk because it is specific to that of a company. So Naveen, you are rightly said that leverage, because of the leverage, that means because of the higher introduction of debt in the capital composition, the equity beta is more higher compared to what it was there, and hence it justifies the increase in the value of the equity. Okay, so definitely because the leverage has happened, we have introduced further debt and hence the increase has happened. Yes, Naveen, it's unsystematic. Perfect. So let us go to the question number 19 now. Yes. So students, question number 19 says K Limited has invested in a portfolio of short-term equity investments. Okay. Now there is a company that has invested in a portfolio of short-term equity investments. You are required to calculate the risk of K Limited short-term investments portfolio relative to that of a market. So that means it is asking us to calculate the, sorry, it is asking us to calculate the beta. Correct, students? Because if you see, they are asking us to calculate the risk in relative to that of the market from the information given below. Okay. So number of shares are given, market prices are given, respective betas are given, and expected dividend yield is given. Now this I am again relating to one of the questions that was asked in the previous session that Ashish sir also have replied, is basically we have to use the market price as a weight factor, correct? So this is again the same question. We have to use the market price multiplied by the number of shares as the weights. The current market return is 20% and risk-free rate is 10%. Okay. So now first of all, we have to calculate the portfolio beta. For that, we need to calculate the weights first. So I am putting the investments A, B, C and D. There are 4 investments. Now if we see the value is calculated how? 1,20,000 multiplied by 8.58. Okay, so this comes out as 10,29,600. Okay, students. Similarly, for B also, we have 1,60,000 shares multiplied by the current market price of 5.84. So this gives us 9,34,400. Similarly, 2 lakh for C multiplied by 4.34. This is 8,68,000. And lastly, 2,50,000 into 6.28. So this comes as 15,70,000. Okay, students. So now again in weights coming out to be, we will just divide the values with the total. 44 lakh 2,000. Okay, so 10,29,600 divided by 4402 comes as 23.39%. Similarly, 9,34 divided by 44 lakh comes out to be 21.23%. So this will be 21.23%, then 19.71%, and similarly 35.67%. This all is equal to 100%, the total. So now as a first step, we have first calculated the weights. Sorry, then we are given the betas. Betas are already given in the question. 2.32, 4.56, 1.80, and 3. Then weighted beta is just multiplication of beta with the respective weight. So 2.32 multiplied by 23.39%. So that comes out to be 0.5426, 0.9681, 0.3550, and 1.0701. So the total beta, weighted average beta of the portfolio comes out to be 2.9358. Now the portfolio beta, or in the language of quotient, because quotient is asking us to calculate the risk of K limited short-term investment relative to that of a market, which is beta, correct? So portfolio risk relative to that of market is equal to 2.9358. Okay. Now the next part of the question is, they're asking us to advise whether K Limited should change the composition of its portfolio. Whether they should change the composition of its portfolio, yes or no. See, now already there is a portfolio, correct? We have to evaluate this portfolio. Now, which evaluation technique we should use? We are not, in this case, what we have to do is, this is the given data and this is the required outcome. We should use the Jensen's alpha, which is we should compare the CAPM return versus the actual return. Correct? Because we already have respective betas, we already have respective expected dividend yield. So can we calculate as per CAPM either the return or beta? So let us try to see that how we can relate it. First of all, let us calculate the overall return, which is the portfolio return, because individual returns are given to us, right? So the first one is 9.5%. Second one is 14%. 7.5% is C, and 16% is the D's return. Then weighted return. Weighted return comes out to be 9.5 multiplied by weight of 23.39. Okay, so this is 2.22%, 2.97%, 1.48%, and 5.71%. So hence the total here is 12.8%. Now for the overall portfolio, we should expect a weighted average return of 12.38 with a beta of 2.9358. We are also given the market return as well as the risk-free rate of return. So can we, using CAPM, calculate the implicit beta? What should be the right beta to get 12.38%? Can we calculate that? Yes. So using CAPM, beta of portfolio, what it should be, correct, is what we're trying to answer. So if 12.38 is the return on portfolio, risk-free rate of return is how much? 10%, correct? Plus beta is what we have to calculate. So what we're trying to calculate here is that what is the right beta? What is the right beta to earn 12.38 on the portfolio with 20% and 10% as market return and risk-free return respectively. So 20% minus 10%. Okay, students. So if we are given that 12.38 is what you have to achieve. So what is the right beta? Beta as per this comes out as 0.238. So now 0.238 beta. See, now here is the catch. For earning 12.38 percentage of the return, your implicit beta or your implied beta should not be more than 0.238. But actually the beta that you're carrying is 2.9358, which is almost very, I mean, very high. Correct. So either you have to reduce your beta, or for the same level of beta you have to earn higher to has to compensate for the higher loss. Correct. Either of the two things. Now definitely from this we are able to understand that implicit beta is lesser than weighted beta. Hence there is a need to change the composition. So what I'm writing is, since portfolio beta, current portfolio beta, which is this weighted beta, whatever is coming out from the weights, since portfolio beta is higher, or I should say substantially higher, because it's actually substantially higher, correct? Is substantially higher compared to implicit beta. So now what is implicit beta is? Implicit beta is what beta should be there as per CAPM in case we are going to earn 12.38 kind of a percentage return. Given 20% as market return and 10% as risk-free return. Okay, this is what implicit beta is. Hence, the portfolio composition should be changed. Okay, now we have advised that portfolio composition should be changed. If yes, then we have to also answer that which security we have to increase the investment and which security we have to reduce the investment. Now for doing this, we will take use of Jensen's alpha. So again, using CAPM, we will calculate the expected return. We already have the actual return, and we will compare the expected return and actual return and analyze whether what should be the decision. The same way we did in question number 4 today, the left part which was there. A, B, C and D. Here we are using the expected return as per CAPM. Expected return as per CAPM is risk-free rate of return plus beta of A. Beta of A is given as how much? 2.32. So 2.32 multiplied by 20% minus 10%. Correct? So this gives us that if there is a beta at 2.32, the expected return as per CAPM should be 33.20%. This is the bare minimum expected return percentage as per CAPM, because you're carrying a very high beta. Correct? You're carrying a very high risk in relation to that of a market. Similarly, for security B, it is 4.56. See the kind of beta that security B is carrying. It's phenomenally high. So 20% minus 10%, it comes out to be 55.6%. The minimum expected return on security B should be 55.6. Similarly, for C, it is 10% plus 1.80, 20% minus 10%. The return should be expected as lower because the beta is also lower. And finally, for D, 10% plus 3 is the beta, 20 minus 10. So 40% is the expected return on security D. Now we know that what is the expected return on different securities. We also know the actual return. The actual return is also given to us in the question, right? that how much expected dividend yield is there. Okay. So the actual return, I am just plotting what is given in here: 9.5, 14.0, 7.5, and 16 percentage. This is what the actual return is. Now, if you compare, actually the return that we are getting is lesser. So this return is lesser in all the shares. Actual return is 9.4, expectation is 33.2. So if you expect to get 33.2, but actually you're getting 9.5, what will be your decision with that investment? It's very logical. You will sell it. You will not want that investment to be in your portfolio. Similarly, the return you're getting is 14, but your expectation is 55.6. So there is no point in purchasing or holding it. We will have to sell it. Similarly for this and similarly for this. So what we are trying to say is that none of the security, the CAPM return is not, the expected return as per CAPM is not to the mark what actual return we are getting. So either beta has to be reduced or the return has to be increased. Hence we are selling all this. So what we have to do is we have to completely sell off the entire portfolio of A, B, C, D and evaluate any new security which is having a lower beta and higher return, because all of them are not perfectly giving us the expected return, bare minimum expected return. So all investments are overpriced. The term that we used is overpriced. Overpriced is because expectation is higher but delivery is lesser. The actual delivery is less. So these are all overpriced. They should be sold and new securities to be invested. So the investment should happen in new securities. Now there is a very good question from Namita. Let me answer that once you absorb this information. Okay, so Namita is asking in this question why we calculate implicit beta. What happens if we use the weighted beta? That is also one of the approach. Now let me solve that using that. Okay, I'll explain. The conclusion will be the same. See, now what we have done is we have in this equation, if you see, we have taken beta as calculation. I mean, we have tried to find out beta by equating 12.38. So this is what implicit beta we have calculated. But in the same part, the second way to calculate is, I'm just putting the alternate way here. This is Namita for your query, so please pay attention. So alternate part, what we can do is using CAPM, we can find out that what should be the expected return on portfolio. This we can find out by putting beta. So return on portfolio is equal to 10%, which is the which is the risk-free rate of return, plus beta of portfolio. Beta of portfolio is computed as 2.9358. So here we are saying that for 2.9358, 20% minus 10% is the risk premium. What should be the return on a portfolio? So this comes as 10 multiplied by 2.935 plus 10. So 39.35 is what the expectation is in terms of return of a portfolio. So expected return is how much? 39.35. Actual return is how much? Actual return is also given, right? Actual return we have also calculated 12.38. Correct? This one 12.38. So this 12.38 actual return is far lesser than the expected return. That means again this entire portfolio is overpriced. Entire portfolio is overpriced. So yes, then definitely there is a need to change the composition of a portfolio, correct? So hence, if you go by this alternate or calculate the implicit beta, whichever way you do, the conclusion remains same. Here also we have concluded that the portfolio composition should be changed. There also we are saying that the portfolio composition should be changed. I hope, Namita, this answers your query. Okay, so there are both the ways. You can use any way to see this. Now Namita is again asking in, sir, in question number 17, why the relevance of assumption that there are no short sales. So Namita, that question number 17 was related to the Sharpe's optimum portfolio, number 1. Number 2, in Sharpe's optimum portfolio, we have given steps of 7 steps that we have to do as a conclusion. There is no derivation there is no nothing. Now the assumption why it was given is that, see, there are 2 ways to reduce the risk. One is that you invest in a lower risk securities, correct? Or second is you borrow from the higher risk securities or from the zero risk securities and you invest in the lower risk securities. Borrow means you divest or you short sale. So what you are going to do is you are going to short sale, and then also you can perform a lower risk portfolio. So that is not what the question was asking or was the intent to ask from you, that you don't have to assume any short sales, correct? You just simply have to do those Sharpe's optimum portfolio steps and arrive at a solution. As I told you that using short sales also you can reduce the risk, correct? Some part of it we will be going to touch in the derivatives also, because they are using short sales, you can reduce down the risk, correct? But as far as portfolio is concerned, on the optimum portfolio, that is why the relevance of assumption was there. Okay, that you don't have to reduce your portfolio using the short sales. You have to reduce the risk of your portfolio by selecting the right proportion and right security. Okay. Naveen is saying, why have they considered only dividend yield? Why not capital appreciation? Okay. Naveen, actually, I was expecting this question. It's good that you asked. Very good. Because if you ask these kind of questions, I get to know that the understanding is clear. So perfect, bang on, Naveen. Why you are asking is that they have only given the expected dividend yield. They have not given the capital appreciation. Although as per what we have studied in the first session, that return is the sum of capital appreciation and dividend yield. Since in the question there is no capital appreciation that is given, hence we will say that whatever is the dividend yield is equal to the return. Because there is no other fact also given in the question through which we can derive the total return including the capital appreciation. Okay. Now, the last part from my end in terms of the conceptual understanding is on the 3 types of lines. Okay, now all of you please listen very carefully, because I'm just wrapping up the entire portfolio now. Because in this we will discuss some of the 2-3 points that we have discussed earlier. So we will first study that there are 2 types of line. This we have briefly touched in during the discussions, the respective discussions. So there is a line called capital market line. This is important from theoretical and practical aspect both. Okay. Then there is a securities market line. Okay. Now, students, if you see, before we go and study any line that is there on a graph, correct? Let's say this is the line. Okay. The way it is there are two attributes to that particular line, correct? This is y-axis, this is x-axis that we know. So there is an intercept and there is a slope, correct? Slope defines that line will be like this, or like this, or it will be a flat, or it will be a straight line, whatever it is, that will be defined by slope. intercept is the point where it cuts the y-axis, correct? This is the basic thing that we have already studied. Now keep these things in mind. Let us go here. So what does capital market line says is that if on x-axis you take standard deviation, okay, just mark the things. What I'm trying to say is it is standard deviation, and if you take the return here, r, okay, if you take the return here and if you take the standard deviation on x-axis, for all the combination between the return and standard deviation that will be there, there is a line that will be formed. So this we have studied in the efficient frontier of given under the Markovitz portfolio theory, right? The same graph we have studied in which on x-axis we plot standard deviation, on y-axis we plot return, and then we try to plot all the portfolios, and then we say that there is a line like this, there is a frontier like this will be the efficient, because for all the portfolios that will come here, there will be the highest return and lowest standard deviation as compared to others, correct? But this is what we have already studied. So I'm borrowing the concept from there only. And we also studied in that if we take a intercept on return and draw one line like this, which will intercept that, which will touch this frontier, okay, this is called as capital market line. So basically I am saying that this is point C where they are intercepting, okay, and the intercept here is the risk-free rate of return, correct? So this is the risk-free rate of return, and the next point is all the portfolios. So I am putting here as B, okay. So all the portfolios from RF to C and C to B, there are two segments, right? One is this segment and one is this segment. So all the portfolios from RF to C will be called as lending portfolios. And all the portfolios from C to B will be called as borrowing portfolios. I'll tell you why. Now students, please note that wherever this line touches the efficient frontier, this is always coming here and this is the market standard deviation, okay? The point here will always be the market standard deviation and this will be the market return. So basically return on market, I am saying this C is where the market is currently. This is the market portfolio. The entire market will be here at C, okay? This is the market. That is because where RF line, this line touches the frontier, at that point the market is there, okay? Now, why do we call as lending portfolio? Because if you see, all the portfolios before this will carry a risk lesser than market, correct? If they carry a risk lesser than market, that means there are some securities that you have invested which carry a risk-free return, correct? That means you have invested some amount in the risk-free return securities, and hence it is called as lending portfolio. If you talk about this part of the line, so these are all borrowing portfolios, because in this case your risk is higher than the market. The risk of a portfolio is higher than the market. Okay, so this is on the theoretical part. Now the equation also we have studied, that return on a security is equal to risk-free rate of return plus RM minus RF divided by standard deviation of market multiplied by standard deviation of security. This is also one of the equation to calculate the return on securities while we are given the standard deviation of market and standard deviation of security. Now what I'm trying to say is that this is intercept here. This is intercept, correct? This is the slope. and this is the standard deviation of that particular security, which is the independent variable. This is independent variable and this is the dependent variable. Okay, students. So this is what I'm trying to say is that in this capital market line, this is what the equation of line is, because if let's say the question comes that what is the capital market line equation, so we can plot the RF and these details and keep standard deviation of S and return of S as the two variable. Okay, this is what the capital market line is. Now let's come to the securities market line, or let me plot it here only so that it is better to compare. Okay, now this is the securities market line which is given under CAPM. This is capital asset pricing model, correct? In this, instead of standard deviation, you put beta here on x-axis and return here on y-axis. The return is same. Okay, now in this case also there is this kind of a line that will be formed. And what is the equation or equation under CAPM that we have already studied, right? So that is return on securities is equal to risk-free rate of return plus beta RM minus RF. This is beta of security, right? Beta of that security. If I divide this RM by RF of beta by market, beta of market is always 1, correct? Can I divide by beta of market? Yes, because it is always 1. So don't you see that both these equations are almost same, except for the fact that capital market line always works on standard deviation, securities market line always works on beta. Okay, now this is what? This is the dependent variable again, correct? This is again the intercept. Intercept means this part is RF. Okay, beta is independent variable. And this is finally the slope. Now here comes the last point in both these capital market line and securities market line. Can anyone tell me what is this slope? We have already studied both these slopes in some different form. So the capital market line slope is what? RM minus RF divided by standard deviation of market. Similarly, for this also we have studied RM minus RF divided by beta of market. This is nothing but Sharpe's and Trenner ratio. Is what I'm trying to say is this is the Sharpe ratio and this is the Trenner ratio. Okay, so what I'm trying to say is that every concept is linked. So your understanding has to be perfect. So this is for capital market line, this is Sharpe ratio and this is the Trenner's ratio. And both of them works on this. One works on standard deviation, another one works on beta. This is it from my end on the two lines. Then there is one third line also, which is characteristic line. Securities characteristics line, which actually measures the excess return on security and excess return on market. Here you will have excess market return and here you will have excess security return. And similarly the line will be like this, and the equation we can easily form here, Ri minus Rf, which is the excess security return, is equal to alpha plus beta Rm minus Ri. Sorry, Ri minus Rm minus Rf. So this is the excess market return, excess security return. Alpha and beta are the same that we have studied in the Sharpe's index model. So this characteristic line also we have already solved a question, but this is what the equation looks like. You can note it for the theoretical as well as for the practical purposes. With this, all the concepts comes to an end. Let me take the question. Namita is asking, previous question, why equity beta rises even if when we buy back the equity, it should reduce. No, Namita. See, the equity beta is increasing because we are increasing the debt component. We are increasing the risk profile of a company, because higher debt means higher risk of non-payment. If the risk is higher, the beta will also be higher, correct? Hence, the equity beta is coming out to be higher. Uh, Namita is asking, sir, on this graph, if we increase return, then SD will also increase. That's right, Namita. And that is what the capital market line says. That if you see this frontier I'm talking about, which is formed under the Markovitz portfolio theory. So this frontier, if the portfolio lies on this frontier, that will be the most efficient portfolio in which the risk is higher and the risk is lower and the return is higher compared to the other set of portfolios. Okay. So if you need any further more clarity, please refer to the part where I discussed Namita on the Markovitz efficient frontier. Okay. So we are saying that return of one security is dependent on another security. No, 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 no. See, Namita, here what we are saying is in capital market line and security market line is return of security is dependent on the standard deviation and here the beta. So here we are saying it is dependent on the standard deviation and here we are saying it is dependent on beta. Okay. Sir, please explain why RF2C is lending. Okay. So RF2C is lending because if you see, as I told you that wherever this will dissect here, this is RM. Let me use another pen. This is the standard deviation of M. Before this, whatever is there, that means we have invested in some riskless investments as well. Then only the risk is lower than the market, right? And hence it is called as lending portfolios. Because we have lent to the risk-free securities. We have lent to, or we have not invested an amount which is there in the market, which is their risk. Namita is asking, sir, what is the use of these lines? Why are we studying this? So Namita, the use of these lines are because these are part of our curriculum. If any some question comes that what is the slope of a market line or some theoretical question comes so that can be answered. At least if sometimes in question you will say that instead of CAPM, they might write what as per the securities market line concept, how will you calculate the expected return? So you need to know that securities market line is nothing but CAPM and this is the concept. Okay. So Namita, that BSc NSE I would not be able to answer because I'm not the right person that whether these lines are used in BSc NSE or not. But what we can say is from conceptual understanding, this C point is where the market is basically. Okay. So with this, the entire portfolio discussion comes to an end. If you still have any doubts, then please do raise. So now I would request C. Ashish sir to please conclude the session and give us the concluding remarks. Thank you so much.
Devas, am I audible?
Yes, sir, you're audible.
Thanks a lot, Devas, because in the conclusion, you have beautifully linked all the three concepts, that is Sharpe ratio, Turner ratio, and how it is derived. Even sometimes a question commonly asked, what is the difference between capital market line and the security market line? So I don't think a student need to cram all this point. If he is very clear about these two lines, he can jot down all the points at his own. There is not an issue. So I think the topic of portfolio must be very much clear to you because you have explained the topic in a very, you can say, very elaborative manner, and every concept you have discussed in very detail. Of course, you have limited yourself to some derivation of the formulas where you are discussing that there are some differentiation techniques are used. If time would have permit and the scope of syllabus like that, so I think you must have even that explained the student also because you are good in mathematics. So it is your, I think it is your caliber or it is your talent. So students, thanks a lot for patiently listening. And now Divas sir will in next class will take up the topic of securitization. Okay, this is there is a theoretical topic, but sir will explain you this topic in a very good manner so that it will be very clear to you. So if you have any queries, as we told earlier, that you can send us an email. Just jot down our email IDs. It is sfm-final@ici.in. You just send your queries there, or you can contact me over the telephone. My contact number is 0120 30 459 3045956. Okay, student, you can contact me at directly this number. So till then, you prepare yourself for this topic, and if you have any query, please send us the email. Okay, Divas, thanks a lot for your time, spending your time, precious time, and delivering the lecture on this very, you can say it is a technical topic so far as a SFM is concerned. And also this topic is very interest of the student because normally students are linking with the market. Right. But as we have given the disclaimer in the very beginning, this is not meant for your trading purpose. It is only for your academic purpose. Yes. Okay, Devas, have a nice day. Thanks a lot.
Thank
okay,
you.
Students. Bye.